Here we are, folks, with John Jentz, who is astride the uranium sector. And specifically today, we're going to talk about something big which has happened. IsoEnergy and Consolidated Uranium have agreed a merger, and we're going to talk about it with John. John, you also sit on the board of Consolidated. You're also sitting on, you're running Latitude Uranium as well. So what can you tell us about this big move?
I mean, I think it's a great move in the uranium sector. It's what the industry's been asking for. It's what everyone's been asking for. It mimics other sectors. I mean, when you take sort of a step back from all this, to my knowledge, there's no one else in the uranium space. You might argue Cameco a little bit, but a little bit long on the tooth. But I mean, when you take a giant step back and sort of look at extractive industries, mining, oil and gas, where you're taking stuff out of the ground, and your mine life is by definition, the wall is always somewhere and it's coming towards you. Could be 20 years, could be 2 years, but it's coming. You know, the ideal look and structure of a company, if you want a sustainable business over time, if you want to promote, you promote, and it is what it is. But if you want a sustainable business over time, the structure, look at the successful companies, 4 to 8 assets in at least 2 jurisdictions to remove some of the jurisdictional risk, ideally in the same time zone, although companies have proven that's not a prerequisite, because it helps on 3 big things that I'm not sure investors really have a full appreciation for. One is, at any one asset, the asset can be overperforming or underperforming at any one point in time. Doesn't mean it's good, bad, or indifferent. It just means if you have a portfolio of them, one's overperforming, one's underperforming, the 6 in the middle are doing okay, and everything's okay. So everybody likes smooth earnings, and it looks like although it looks like a smooth dividend grower. That's what people want to see. That's fine. And from a business standpoint, that also allows you to hire and retain, which is quite difficult. I mean, if you're a young 25-year-old geologist coming out, would you like to work at NextGen? Sure, because it's a great asset. And it's going to be a spectacular asset. But you have to ask yourself, what next? Where am I? Conversely, in the gold sector, if you had to work at like a small producer, okay, fine. But then you look at where I work at Agnico Eagle. I can go here, I can go there. I've got 6 other people I can talk to. I don't have to worry about metallurgists. I don't have to worry about money. I don't have to worry about all that stuff. I mean, it's difficult to hire and retain good talent on a permanent basis or on a longer term basis if you don't have an asset portfolio that you can see over time is going to be replenishing itself. Lastly, it's just growth, and people want to see, as you take away if you take away stuff out of the ground, you have to at least replenish it, and people want to see growth. And unless you have the assets in your back pocket, it's not the easiest thing to do. And so you need a portfolio of, 4 or 6 grassroots projects, 4 or 6 development projects, 4 or 6, near-term production projects, because not all work, not all are the same, not all are going to get permanent on the same time frame. And it's great if you're BHP and RTZ and all that stuff, and you're a behemoth and you can sort of, lug 5-10 year time frames. But if you want to structure it intermediate properly, 48 assets, at least a couple of jurisdictions, and that's what you need. But if you have one asset, getting the second asset, it's not that easy because you have to time it, you have to finance it, you have to do all these things. And so I think with ISO and Consolidated, I think what they have is they have a suite of projects in good jurisdictions. And I think that's the other thing is that people will start to more fully appreciate the better jurisdictions. I've worked in Africa for over a couple of decades. It's just getting increasingly more difficult. I mean, we can go on and on about these things, but Canada, US, and Australia, they're all known places. And, over time, that's going to command an increasingly larger premium. And to get these assets as the price moves up it's not, I guess anything's possible at a price, but getting them at a reasonable price where you can actually make money on these things, it's a challenge. So this is a great starter pack, and I think the future is super bright for the company, for the combined company.
Well, absolutely, as you say. So you're saying basically this kind of blended portfolio is important. The attractiveness to what is a big problem in this space. People with experience and people wanting to work in the uranium space is quite important. I think one of the other things that seems to be kind of coming back to us because it's fresh. It's happened today, right? Is the perception that this will give this new entity, this merged entity, access to capital in perhaps a way that they couldn't independent of each other because of that kind of strategic importance. In terms of so I should say, the kind of focused production strategy, they kind of, it's kind of built for the current market as it were. So do you think that's true? Do you think that this is your markets guy? Is this more attractive to the markets?
I think 100%. And I think the reason is that if you're a portfolio manager and you're getting paid some money to manage the money, it's difficult to then invest in an ETF, because the people who are giving you the money, whoever it is, asks you, well, I'm paying you 2%. Why are you paying this other person, whatever, to manage all this? So to a portfolio manager who's actively managing funds, it's, ETFs are less interesting, although they have their spot, for sure they do. You can always buy the spot metal or the spot ETF. That's fine on the inverse metal, but you don't get the exploration upside. You don't get the whip. To the extent the metal price goes up, I guess you theoretically don't get the downside as well. So then therefore, what do you invest in? So Cameco, NextGen, 2 or 3 others, and then what? And so it's okay if you're putting in $100,000 or $50,000 or $20,000. Your selection broadens out a little bit. But if you're a fund manager and you're running $1 billion fund and you go at 2% allocation and say, I need $6 million in something, and I don't want it to be an ETF, and I don't want it to be Cameco, it can't go into Latitude, because you're going to own 15%, unless that's your way. But if you want to serve a passive, interesting stake, you can put $6 million into a $900 million company and still get out of it. I mean, it works, right?
Right. Okay. So I think what we're saying is, broadly, I think that the market reaction to this, we'll have to see how it plays out in the next few days. But as far as the merger is concerned, it makes sense for both companies to do that and it also positions them as one of the kind of much significantly bigger players in the space. And there's benefits to that. Let me ask you though, and I appreciate your position with, obviously, not just Latitude, but also Consolidated. So I'll keep this a broad question, which is, who are the winners in this? Are the Consolidated Uranium shareholders better off than, say, the IsoEnergy shareholders? And I think we've seen the share reaction today. But what's your longer term call on that?
I think both set of shareholders are actually beneficial, because on the ISO side you get a broader portfolio. The ISO asset itself, if you look forward, it's bordering the Cameco Aribo property, which is fine, and it's in a great spot. It's a great asset. I mean, there's, as far as asset value, but being a single asset, being somewhat dependent upon what other people are doing, you generally don't want that. You want to have options and optionality on that. And from a consolidated perspective, they great assets in Canada, some in Canada, but Australia, Argentina a little bit. But if you want to be in uranium long term, you have to be in the Athabasca, and so that gives them access there. You combine the talents of the people. I think that's going to be a very underappreciated at the start, but more appreciated as time goes on. That the actual have the people. I mean, there's people at both companies, and again, assuming people are buying into the plan and buying into the vision, it's it just works so much better. Access to capital works better, and it's really for both set of shareholders, because the risk of going alone on both sides. I mean, there's positives, but there's also downsides, and I think this just makes I look at units of upside, units of downside. There's 4 or 5 units of upside. There's maybe a unit or 2 of downside. So this is for both sets of shareholders, great deal.
It's also interesting. I mean, getting deals like this across the line, certainly when you kind of got a who's who of board members, it's hard to kind of get everyone to agree. But looks like Phil Williams will be CEO and Tim will be president. So it seems they kind of, I don't know how long this was in the making. Clearly, these things take a while. Can you get any sort of insight as to how easy the process was or not?
No, I mean, I think when you have larger shareholders who are bound together by common vision, I think it tends to make things a little easier. The social factors are always a bit of a they have to be managed, and probably the reality is day to day, for at least the first little bit is. Phil knows the consolidated assets very well, and Tim knows the ISO hurricane very well, and so I just can't see that changing materially in the short term. And when there's this amount of, I believe, medium and long-term value creation, people will figure it out.
Right. Okay. But we haven't really talked about what next, because it's obviously it takes a lot to kind of get a deal like this over the line, and lots of conversation, lots of consultants involved in the process. But what do you think the company needs to do next? It's got this new blended portfolio. It's obviously going to have to talk to the market and explain, what their intentions are. Will they be doing that soon? Do they know? Was that part of the agreement?
Yeah, I think until closing is scheduled, I think, for November. And so I'm sure they're going to be, there's a concurrent financing as well, which the big shareholders are subscribing to. We'll see who else is going to subscribe or not subscribe. I can't imagine there's going to be a lot of, I think there'll be plans and a lot of, goodwill exchange up until closing, but until closing, things aren't closed, so you can't really sort of get at it, but you can make plans. But I think the first, typically how we've done these things, the first 30, 60, 90 days, 120 days, there's goals for everybody, lots of communication, lots of integration, both of people, of systems, of all that stuff. And, it's you can't be too on top of these things. And really, to me, the integration is the capital market side, the access to capital, the people, the assets. Is it going to work medium to long term? I don't really have an issue with that. It's more, I'm more focused in the short term about the integration of people and systems, and just making sure that wherever that line is going to be, we start it from the highest point and make it the highest trajectory.
Okay, it'll be interesting to see what the market commentary is. Obviously, you've got Energy Fuels in there, Mega Uranium in there. So lots of people with vested interest to make this thing work. So what does that mean now in terms of the broader context of the market? Do you suspect we'll see more M&A? Do you think that people will try and emulate this? Where's that going to come from? What's your view?
I'm sure people want to emulate it because I think it's going to get traction. But I think the challenge for us and the challenge for other people that are trying to sort of emulate the story is that getting, anyone can say near-term production. That's all fine. That words are great and things look great on PowerPoints. The reality is, in the U.S. at least, we have the only agreement with Energy Fuels, who is the only permitted mill in White Mesa in Utah, and we have a good relationship with Mark Chalmers, and so. I don't know. You tell me when the next mill in the U.S. is going to get permitted. I know it's critical. I know all the governments do that, but actually trying to get things done on the ground and permitted ground and crown lands and the BLM and all the stuff. It should all work, but it just the government should shut down either. But the government does shut down because there's bipartisan politics and all the rest of it. In Canada, again, you need Canada and Australia are both great jurisdictions. But the permitting process, to be quite frank, is a little bit longer than other places. You can get something permitted in Africa in 12 months, 18 months. Great. But in 3 years, they can also take it away and change the code on you. Whereas in Canada and Australia, that just won't happen. So, it's a little bit more of the investment up front to get there. And when you have a single asset, it's a little bit more challenging because people are, somewhat impatient and chomping at the bit and wondering about every little turn. But when you have a portfolio of assets, you're showing production and cash flow out of the U.S., you're moving things through the product pipeline. There's always something happening. There's always an asset coming in, and you take the best assets, and that's why you have a portfolio of them. That's why I think investors are going to gravitate towards this. This to me is really going to be the de facto ETF for non-ETF buyers, if you will.
Well, you can't say further than that. Well, look, I'm sure we'll talk about it again once we see how this all plays out. You make some good points then, especially access to White Mesa Mill in North America. John, appreciate your time and your insight. I'll speak to you soon.
Okay, thanks, Matt. Cheers.